this video, we're going to look at factor-based strategies within the context of following an index. Now, when we talk about following an index, it normally makes us think about passive investing, where we are aiming to not beat the market, but follow the market essentially, and do it in a low-fee, efficient manner. And that means that we are aiming for the beta of the market. We're essentially taking the market risk and accepting the market return. Now that's fine, that's what we do if we were taking a fully passive approach. But what we're looking at with factor-based strategies is just adding to that. You may have heard of smart beta. And that is what we're looking at here. We are taking a bit of a positive exposure towards various risk factors because we think those risk factors may deliver a return premium. So is it active? No, not really. We're not really chasing the alpha. We're not looking for underpriced and overpriced individual stocks. We are looking for exposure to risk factors, but we are still following an index. It's just that that index may be moving away from a typical market cap weighted index. So it's sort of straddling the line between active and passive investing, and hopefully with some of the benefits of both. Okay, so let's think about what we mean by these risk factors. So if we were in a world of the capital asset pricing model and our market cap weighted index, then we'd be focusing on this first risk factor here. So the market risk, which we measure by beta. But as you may have seen in other parts of the curriculum, in your journey to this point, you know that there are other risk factors. And you probably first met this back at level 1 with the idea of the FAMA and French idea of just adding more exposure to risk, more risk premiums. So we're just giving an example of here. This is not a particular model. It's just getting you to think of the kind of things that may deliver a return. So for example, choosing to invest in smaller firms rather than larger firms. The style being growth versus value. So growth, you're looking at the companies that are going to grow and deliver their returns that way. Value, essentially, you're looking for the companies that are cheap. And prior returns, the idea that once a stock gains momentum, it may continue to go upwards and deliver price returns. So those could be our various risk factors. And indeed, there are others like the liquidity, volatility, for example, of the stock, and firm quality or otherwise, so the consistency of its returns. So don't feel that that is a list to learn for a particular model or anything. It's just getting us thinking about the sorts of things that can lead to these risk premiums. So I've mentioned CAPM a few times. We call that a single factor model. I know it's got 3 different things in the calculation, but we've got the risk-free rate, which is your starting point. Then you've got your market risk premium, and how much of that you deserve is driven by your exposure to market risk through the beta factor. And you've met that model